And thank you, everybody, for joining today's Brainstorm Study Group webinar. I'm Chris Orestes, the president of Retirement Genius and your host. It's great to see so many of you back again to join us this month. A lot of familiar names and friends and faces that have been coming every month to participate in our study group sessions. We've been covering some great topics, hot topics, current events, and issues that really impact particularly seniors that are looking to build and or live in a very fruitful retirement. Happy to have you on board for this month's session. We're going to talk about anxious America and their thought that it takes $1.25 million in the bank to retire. But the question is, what is the reality? Retirement Genius is an information and resource platform that is dedicated to helping people achieve a well-balanced retirement. We focus on financial, health, long-term care, and lifestyle information and resources. It's our belief you need to bring all of these factors together to help people build a well-balanced retirement so that they can, as we like to say, retire like a genius. So what are we looking at today? Well, Americans have grown understandably anxious about what it's going to take to retire. What it takes and what retirement even looks like today has just changed vastly in the last 10, 20 years. What was my grandfather or father's retirement is certainly not what retirement looks like today. And since 2020, we've gone through a lot of shocks to the system. We battled COVID. There's been a lot of political instability. We're still seeing it play out today, every day in real time. We've seen inflation hit. We've seen inflation and unemployment at some very high levels, now coming down to lower, more historically normal levels. But none of that is fully under control, and it's left people feeling very anxious and unstable about their prospects for retirement. And when a survey was released earlier this year, asking people what they thought they would need to be able to retire, a number of 1.25 million was put on the table as what would be necessary to be able to retire. The reality is that 50% of people in the end are going to end up overly reliant on Social Security to make up more than half of their monthly retirement income. So the question is 1.25 million the right number? Does it make sense to have a set number, that one number as it stands now, 1.25 million? And what role does Social Security, and for that matter, Medicare, play in building and living a secure retirement? What should people be keeping in mind as a part of their retirement, not the totality of their retirement, but a part of their retirement? So what can people do to ultimately achieve what everybody wants, and that's to retire like a genius? Well, the first question is, are people saving enough in their retirement? Well, when you look at the current saving levels, the numbers are pretty sad. The average amount in a U.S. retirement account today is about $65,000. Now, for people ages 55 to 65, when they're getting closer to the reality of retirement, they really start to try and catch up and put away as much as they can. So, they're looking at about twice that amount that they've managed to put away. But for people that are 35 and under, they're still very low in the amount that they've managed to put away for retirement, at least at this point. And if your goal is to put $1.25 million cash away, or cash equivalents for your retirement, those numbers aren't going to get you anywhere close. So instead of a number, an arbitrary number like 1.25 million, what I always look at is the ability to replace 70% of your peak income to sustain you as an annual number over your retirement. So instead of a number, really, it's a percentage of income. But if a person waits too long to start saving, hitting that 70% is really difficult. If you start early, if you start by the age of 35, you'd need to be putting away about a quarter of your income to hit that 70% mark. But if you waited just a year longer, you waited till you're 45, you'd have to be putting away almost half of your income to hit that 70% replacement mark. So we're always encouraging people, as soon as they start working, coming out of college, to do all they can to tame debt and start saving and investing as much as possible in retirement vehicles, taking advantage of 401k plans, IRAs, and trying to beat back debt as much as possible, keeping that as low as possible, so that you're giving yourself as much time as you can to have the impact of compound interest, tax deferred growth to get to those numbers. But waiting, people who wait too long find themselves battling an uphill battle, and it just gets more steep the longer you wait. And then you've got to take into account the realities of the impact of healthcare and long-term care costs. I always say one of the smartest investments a person can make is in their health, because the impact of health and long-term care costs as you're aging can devastate somebody's retirement. It is hard enough to save and live on a fixed budget in retirement if all things are even and you're healthy. You throw in the impact of a serious health or chronic health condition starting to eat away at that, and it can be very, very difficult to keep your head above water once you're carrying that burden in retirement as well. And for a lot of people, they think they're never going to need long-term care, that they're going to stay healthy, that they don't really take into account that reality of what those costs can be. But we know the truth is 70% of people over the age of 65 are going to need some formal long-term care. And there are millions of people in formal care settings, whether it's home care, skilled nursing, or assisted living in this country. And that doesn't even take into account the unreported care that's being delivered by friends and family, those informal care providers that quickly start developing into becoming full-time care providers for loved ones. The reality is, for a couple at the age of 65 today, they can be looking at spending as much as $300,000 on the costs of health and long-term care once they hit their retirement years. And those costs of care are expensive. They are growing every year. You're looking at easily this is just an average, $5,000 for home care, but we know that can cost twice as much in some parts of the country. Assisted living, skilled nursing, these are expensive monthly costs. Now, for most people who are getting home care or assisted living, that's private pay. That's coming out of pocket. Skilled nursing, for most people, that ends up becoming Medicaid. And when you look at how the costs of long-term care are divided up across the various care buckets, Medicare and Medicaid together is covering about over half of those costs. Private pay, about a third, is out of pocket. And then you do have a small slice of it that is covered by long-term care insurance. The problem is there's just not enough people carrying long-term care insurance, and certainly not enough people who can self-insure and just afford to cover these kind of monthly costs out of pocket. So the problem, though, is the disconnect between people's perceptions and the reality. People say that to them, they're never going to need it. It's something that is just not going to happen to them. But the reality is that it will. We see that 70% of people do need long-term care in their life, in their future. A majority of people say that if they experience some kind of a health crisis, that would prompt them to want to purchase long-term care insurance, plan for long-term care insurance needs. But we know that for a lot of people, that's a point where they become uninsurable. People have a misconception that if it happens to them, that they'll be ready, that it'll get handled. They'll figure it out. They'll have the money. But the vast majority of those same people say, but it's never going to happen to me anyway. Well, what's the landscape when it comes to how people have prepared for that? Well, long-term care insurance, you've got about 7.5 million in-force long-term care insurance policies in this country today. You've got about 250 to 260 million life insurance policies in force in this country today, with trillions of dollars of in-force death benefit, and about $2.5 trillion of in-force premiums in annuities. Annuities have had big years the last 2-3 years, with people seeking flight to safety and looking at annuities as a safe, smart place that they can put money for the immediate and long-term needs to protect and have income for themselves or loved ones. So what is the reality around the cost of retirement and long-term care? Can people rely on Social Security to fund all or more or most of those costs? Well, for a lot of people, Social Security has become the primary source of their retirement income. You've got about $1.2 trillion in benefits that were outlaid to 70 million people in 2021. For about a quarter of all seniors in this country, Social Security ends up being about 90% of their income. For about 50% of people in this country, Social Security makes up about a half or more of their monthly income, relying on Social Security. There's also the additional overlay of Medicare. Once people turn 65, Medicare will kick in and become part of their healthcare equation. For most people, it's not required that you start taking Medicare at 65, but if you're no longer covered through employee coverage, you can elect to now take Medicare. But what people don't realize is that Medicare has costs. There are out-of-pocket costs. You're paying premiums, ongoing out-of-pocket costs with co-pays, deductibles, co-insurance, and even Medicare Part B's premium is deducted automatically from your Social Security check every month. A recent Go banking rate survey found that 20% of Americans will end up relying on Social Security to fund their entire retirement, and that this is people what they're predicting for their own futures. And about a third of people said they're expecting it's going to be at least half of their retirement costs. The reality is those numbers are even higher as we're experiencing it today. So what we always tell people is that they should not look at Social Security as their sole source of retirement income. It really is designed to be a piece of the puzzle. It's more of a supplement to people's savings, investments, maybe pension. And when you consider the fact that the average monthly Social Security check in this country is $1,700 a month, and that's just a bit above the poverty level for a two-person household, you really don't want to put yourself in a position where this becomes all or the lion's share of your retirement. So what are some strategies to get the most out of Social Security benefits? It is ultimately going to play an important role. At least today, it's playing an important role in so many people's retirements. So here's some strategies that can help people get the most out of their Social Security benefits. One is the age you elect to start taking Social Security. You can start taking it at 62, but the longer people wait to take their benefit, the higher the payout will go. Now, if somebody has some serious health issues, they're seriously underwater economically, and they don't have a choice, at 62, you can take your benefit. But if somebody's in a position to wait at least until they get to full retirement age, it can make a big difference. So if you look at where things are in 2023, a person who waits till full retirement age would be collecting $3,627 a month. That same person, if they waited until age 70, if they were entitled to the maximum benefit levels, could get to $4,555 a month. But that same person, if they started collecting early at age 62, would be collecting about half of what they could get if they had waited till age 70. So here's the simple math. Start collecting at 62, you're looking at about $2,500 a month. Wait till age 70, $4,500 a month. Split the difference. You wait till you at least attain full retirement age. That's $3,627 a month. Now, people can also continue to generate income while they're on Social Security. And I always encourage people to stay active, stay engaged, have meaningful purpose in your life. And hey, if you can generate income while you're doing that, all the better. But there are tax implications with your Social Security benefit. If you're collecting Social Security and you're making more than $21,240 annually, then you're gonna experience a tax against your Social Security benefit. You'll see your Social Security benefit drop against the amount you're making, and that can impact anywhere between 50 and 85% of your benefit, depending on what the income level is you're generating. But up to $21,240, it'll have no impact on your Social Security benefit. After that, you do have to start to expect, and I see this happen all the time, where all of a sudden somebody's making some money, they're above this income, they're above this earning level, and they're surprised to find out that their Social Security benefit has decreased as a result of it. It's also important to factor in that the Medicare Part B premium is going to be deducted automatically from your Social Security benefit. In 2023, that's $165 a month that's being taken out of somebody's Social Security check automatically towards that premium obligation on a monthly basis. Also, Social Security for the last couple of years has had some pretty big COLA increases, which is a direct result of the unfortunate reality of inflation. So in 2022, you had a 5.9% COLA adjustment, and then in 2023, you had an 8.7% COLA adjustment. Some major COLA adjustments reflecting the reality of where inflation was at that time. But in 2023, inflation has been coming down, and it's going to be a lower COLA adjustment projection for 2024, looking at about 3.5%. And this fluctuates. There have been years where there's no COLA increase at all, but right now it's looking pretty certain that there will still be a COLA increase of 3.5% that would take place starting January of 2024. It's also important to remember that people that are spouses of either a deceased or a divorced partner, there are benefits that they'll be able to collect based on their ex's benefits. If their ex's benefits are higher than their own, they can be entitled to collect based on their ex and an ex's status, whether they're deceased or divorced. Now, if the person is going to remarry, they still can collect based on their ex-spouse, but only if they wait to remarry after the age of 60. So you'd have to kind of hold on for that if you wanted to be able to still access your former spouse's benefits. In the case of a divorce, an ex-spouse can collect up to 50% of their ex's benefit if they're 62 or older, or they were married at least 10 years and now are single. So somebody who can collect based on divorce status, you've just got to factor in your current status as well as your age to be able to tap into a divorced spouse's benefits. So when is the right time to retire? Social Security plays an important role. Those are some strategies to maximize your benefits, to get the most out of your benefits. You always want to look into those factors. What's the age? What income are you making? Do you have a spouse, ex-spouse, deceased spouse? Those are all important factors to understand the management of your entitlements. The goal is that people have as much possible in savings and in investments to be really the bulk of their retirement, but Social Security, Medicare, and possibly even Medicaid during some of their long-term care years are also a factor. So when is it the right time to actually retire? Well, one thing that most people have to factor in is that early retirement, say in your 50s or even early 60s, can become problematic. You're missing out still on some critical income years to save, invest, and grow towards your later 60s, 70s, 80s. And don't forget, if you retire before 65, you're going to have to figure out how to carry your healthcare costs. If you don't have if you're not, say, on someone else's coverage, you're on your own, you're not going to get on Medicare until 65, even if you got on to Social Security at 62. And a lot of people get caught in those 2 or 3 gap years where all of a sudden they're digging in their pocket waiting to get on to Medicare. So early retirement, except for those fortunate few, is problematic. Having that additional time is going to be critical. Another 10 or so years, getting into your mid, late 60s is going to make a big difference. And then all the way through from as early as possible. What my oldest son, as an example, is 25 years old, graduated from college, started his first job. The first thing he did when he got his benefits was sign up for the 401k and make sure he was putting in as much as possible to at least get the full match coming from his employer. And he'll continue to increase what he's putting in that 401k. So he'll start putting money into a 401k at the age of actually even 24. He turns 25 this month. By the time he retires, that will be 7 figures of money put away because he starts now and will continue to put that money away for the next 3 or 4 decades. The sooner and longer and the more up to the maximum amounts that anyone is putting into IRAs and 401ks, it's going to make a huge difference. If you've blown that stuff off, and all of a sudden now you're in your 50s and you're starting to scramble, you've just lost so many years of the advantages of compound interest, tax deferred growth, to get to do so much of the heavy lifting to get to your retirement goals. There's some other important considerations, such as we've covered, like the retirement age, when you take your Social Security, when you start going on to Medicare. And it's important to be cognizant of when you start tapping into the funds that are invested in IRAs and 401ks, and the ages that people could also start to take advantage of alternative funding vehicles, such as things like reverse mortgages, veterans benefits, life settlements for people who still own a life insurance policy. Keeping straight what the right ages are for those things also become a critical part of the factoring into what's the right age to retire. As we covered, the earliest a person can start on Social Security is 62. They wait to 70, they're going to get a lot more. People who qualify for Medicare at age 65, but you don't want to get caught in that gap, as we talked about, by retiring early. People who are veterans can start to collect on their veterans benefits once they hit age 65. The youngest age that a person can tap into an IRA or a 401k without hitting penalties is 59 and a half, unless they qualify for a number of emergency exceptions. But by the age of 72, you've got to start drawing down. You're going to start taking your RMDs, your required minimum distributions. Now that age range is actually increased now to 73 and will continue to increase over the next few years to 75 as a result of the passage of the Secure Act, which made a number of improvements and accommodations to people, particularly in their older years, to what they can do to put away catch-up contributions into IRAs and 401ks, encouraging people to start putting money into 401ks right at the get-go when they start their jobs. Secure Act has provided a number of, I think, critical provisions to help people overcome some of these challenges to retirement that we all are dealing with on a regular basis. And then for people who want to take advantage of alternative funding options, there's age restrictions, such as to tap into a reverse mortgage, you need to be 62 and above. To tap into using a life settlement and liquidating a life insurance policy that you're still carrying, typically that's age 65 and above, but there are health exceptions for somebody who's particularly has a strong impairment, chronic conditions. There are health exceptions to be able to do a life settlement at a younger age. The key here is that for advisors, it's to be as well informed as possible to help your clients understand the realities and get them off of these misconceptions of that they're never going to need long-term care. It's never going to happen to them. We want to do all they can for people to be operating in reality. And the more they take time to take advantage of the resources, the vehicles that are out there, to be better informed, to make sure they're timing their retirement correctly by understanding the different impacts of age on various vehicles such as Social Security, Medicare, or things like reverse mortgages, life settlements, what have you, the better they're going to do. And you, as agents and advisors, want to position yourselves as being well-rounded, well-informed advisors, and not just trying to sell one particular thing to people. The more you can provide information, access to resources, the more you're going to be looked at as a solution provider, the less you're going to be looked at as a salesperson trying to sell something. And the more business and trust you're going to earn from people, the more referrals you're going to get from people, because your approach is well-informed, well-rounded, and you're opening up the doors to a number of solutions that they can put together to meet the unique challenges that come from aging and declining health that are reality for all people, including ourselves. So I'd be happy to send out a free copy of our Retirement Genius tip sheet. Anxious America says it takes $1.25 million to retire. So give us a call, 866-602-5000. Feel free to email me directly, chris@retirementgenius.com. We always encourage you to visit our advisors only website, advisors.retirementgenius.com, our flagship website, retirementgenius.com. Check out my podcast. We're on the Forbes Podcast Network. We look forward to talking to you every month on our study group brainstorm webinars. We'll be reaching out to you, keeping in touch, working with you, take advantage of the tools and resources we provide. We want to be working with you. We want to be talking to you. Thank you so much for joining us today.